allow banks to resume buying back stock with limitations after they were prevented from doing so earlier this year. Share repurchases made up about 70% of the industry's capital payout to shareholders pre-COVID, but the largest U.S. banks voluntarily suspended buybacks in March as the pandemic-induced shutdowns that roiled the economy and financial markets. The Fed then said in June that all banks subjected to its stress tests were required to halt their buyback programs and cap their dividend payments. Now, in this second round of stress tests today, the Fed said that the banks could restart share purchases, expanding similar limitations already in place with dividends. These amounts are based on a formula tied to the last year of the bank's income. Now, these restrictions will be in place through the first quarter of 2021, and the Fed notes they may be expanded thereafter. The Fed chose to do an unprecedented second round of stress tests this year due to the economic uncertainty surrounding the pandemic. This time, they ran two hypothetical scenarios, one with a severe shock and a quick recovery, another with a more moderate decline but a prolonged recovery thereafter. Now, the projected losses for the 33 banks studied under both scenarios surpassed $600 billion, more than the June test, the Fed said, but the firms maintained enough of a cushion to maintain their minimum risk-based capital requirements. These levels will not be reset after the most recent test, the Fed said.
Leslie, give us a quick note on what these scenarios actually looked like, because the Fed came under fire earlier this year because even the most severely adverse scenarios didn't even come close to what the market experienced in March and April. They couldn't have anticipated that oil would go negative, for instance. And so I'm wondering how closely these two scenarios mirror what's actually happening or could happen in the economy, and what that tells us about the health of banks in these real-time scenarios.
Right. What's fascinating about the earlier stress test from this year in June is that the Fed set the parameters for those tests in February, right before the economy basically fell off of a cliff as a result of the pandemic. And as you're reading through the stress tests, you're looking at the unemployment and the GDP projections and all these other metrics, the market sell-off that they were stress testing. And you were saying, wait, we've actually seen worse than that already this year. So that was the whole point of the second round of testings. They had two separate tests to basically look at two different projections for a stressed economy that makes it so that these banks can really be tested under a much more severe environment than they had earlier this year. And by and large, the Fed believes that the banks held up very well under those scenarios. And that is part of the reason, according to senior officials, that they decided to allow these buybacks to resume. So it's definitely a positive reflection on the banks, with that caveat of additional certainty, hence the limitations required.
Well, we're going to talk about just that, Leslie. Thank you. Leslie Picker.
Shepard Smith here. Thanks for watching CNBC on YouTube.